We'll go ahead and get started. Welcome to the Sortis Rescue Fund webinar. You've got myself, Paul Brenneke, Executive Chairman of Sortis, as well as Sam Ross, who is the Fund Manager of the Sortis Rescue Fund today. Let me start with a short introduction of Sortis. I know a lot of you know us, but I think it'd be helpful for those that don't, just to kind of give a little refresher. Many of you know us through our income fund offering, and we've had our income fund now for about 4 years. It's a lending fund, and we've been very successful with that, and over the last year or so have started expanding our fund offerings, including the rescue fund. We originally started the income fund as a diversification away from what I used to call my day job, which is being a real estate developer. I've been involved in pretty much every asset class of development over the last 30 years, including multifamily, office, hospitality, industrial, life sciences, self-storage, and assisted living. This diversity gives us a broad range of experience that can be applied to both lending and equity capital investment, as well as direct development of all product types. I think it would be helpful to understand more about us and our approach if I describe 300 Pine, which is our current flagship development project that's in its final phase of development. The project is a former Macy's department store located downtown Seattle. It's an 800,000-foot historic building that we've done an adaptive reuse to convert from what was an old department store retail use to office and now new age ground floor retail. Amazon currently occupies about 500,000 square feet of the building, and when complete, they'll occupy about 700,000 square feet. The remaining 100,000 square feet is a highly curated retail development. Within this, we have 25,000 feet of music venue, a 10,000 square foot food hall, a 15,000 square foot entertainment venue, a 30,000 square foot health and wellness and fitness facility, and a 20,000 square foot of traditional retail. We have a direct relationship indoor investment with a number of the tenants in the facility. And this construction entered its final phase in February 2020, at the beginning of COVID. The project is scheduled to be completed in the core and shell in early 21, and with final occupancy for tenants ranging from late 21 to early 22. Now, the reason I bring this up is important to note that virtually all of these retail deals were completed during COVID, relying on existing relationships that we had in place. This specific capability is part of what we believe will make that project successful and make us successful in a very challenging environment that COVID has presented to us. When 2020 started, we had contemplated launching an opportunistic real estate fund. We recognized that we were in the late innings of the current cycle, but felt there were still good opportunities out there. Once we saw the shutdowns happen in March, we realized this was a whole new opportunity. Our collective team had extensive experience during the Great Recession dealing with troubled assets, including distressed loan, bankruptcies, workouts, and failed developments. While we didn't believe it would be widespread like the Great Recession, we knew there would be situational distress where we could create opportunities going forward. Next, I'll introduce Sam, and he can talk more specifically about the Rescue Fund.
Hi, good afternoon, everybody. Thanks for everyone joining us for this. Thanks, Paul, for the introduction. So I'm Sam Ross. I'm a vice president at Sortis, and I'm a manager along with Paul of the new Sortis Rescue Fund. And like Paul said, the Rescue Fund started its life as a real estate opportunistic fund, and then COVID hit the world in February and March. And we realized this would cause a lot of situational distress. and potentially create a substantial amount of economic opportunities for us. The Sortis Rescue Fund was purposefully designed with a flexible mandate, which allows us to acquire real estate, which is the Sortis core competency, but we also have extensive experience in operating businesses, distressed debt, and lending. So all of our capabilities made us realize that there will be more than just real estate opportunities here, and we wanted to make sure that we had a vehicle that we could go out, capitalize on these opportunities, and ultimately generate hopefully what will be terrific performance for all of our investors. In addition to being flexible on what we can buy, we're also flexible within each asset class. So within all sectors that have gone down broadly, there are certain sectors where we do have much better capabilities, those being retail, hospitality, office, industrial, and being in and out of the debt markets, as well as operating businesses. So we've given ourselves a pretty wide berth of what we can do, because nobody quite knew what was going to happen with COVID, and we wanted to make sure we were able to capitalize and execute on what opportunities presented themselves. And with the Sortis Rescue Fund, in staying consistent with the overall Sortis investment theme, we source our deals directly rather than through traditional channels where you end up buying from brokers that only want top dollar. You end up in very intense competitive bidding wars, and with substantial amounts of capital sitting on the sidelines, we felt, number one, those were not the best channels for us to manufacture opportunities. But number two, any opportunities that come through those channels were not going to have the substantial discounts in pricing that we're targeting with this fund. So as a result of our relationships, our expertise, and our flexible mandate, we're able to use our capital in a much more creative, much more nimble, and much more disciplined manner. So the Rescue Fund fits within the overall Sortis family of funds. Sortis is an alternative asset manager based in Portland, Oregon, as many of you may know. And so at this moment in time, we currently focus on 4 main funds. The first of those is the Sortis Income Fund, which is a first mortgage real estate lending fund that's backed by senior real estate liens on property. That fund has historically yielded in excess of 10% net to our investors. And as a result of the dislocations in debt markets through COVID, we've been able to use that as a vehicle to place capital that we view as helping our borrowers solve a unique and specific problem. That fund currently has a large, well-established investor base. It also has a very stable portfolio that has performed very well through COVID, primarily as a result of our disciplined investing approach and our ability to identify and execute on specific deals that have outsized risk-reward dynamics. The second fund that we run is an Opportunity Zone Fund, which came about as a result of the 2018 Tax Cuts and Jobs Act, which created economic and tax incentives to invest capital and develop both real estate and businesses in opportunity zones that historically were underdeveloped communities, neighborhoods, and counties. We have since executed on 5 transactions within our Opportunity Zone platform, 3 of which were real estate, 2 of them were businesses. And I want to point that out because even though those transactions were closed pre-COVID, the underlying theme of each investment fits with how we view broader term trends. And just by way of example, some of our Opportunity Zone transactions have focused on affordable housing apartments, life sciences, real estate, and healthcare companies. The third fund that was launched in early 2020 is the Sortis Growth Fund. That is an e-commerce focused growth investment fund. So we are investing in early stage companies, but those early stage companies are profitable, stable, have founding teams intact, and all they need is capital to take them to the next stage of their growth and expansion. As part of our work with the Growth Fund, we give our portfolio companies not only our capital, but our time, our expertise, and our relationships so that we can truly be a provider and a true partner with these companies and not simply giving them money. So we help them at every step of the way. And then the fourth fund that we're here to talk about today is obviously the Sortis Rescue Fund. And so those four funds comprise the Sortis Alternative Investment universe.
So next I'll talk about our investment thesis. I think one thing to understand is that COVID hasn't changed our core investment thesis. And as we apply that to Rescue Fund, we believe there were certain trends happening pre-COVID that we think will continue post-COVID. What this has done is given us an opportunity to participate at a great basis in some of those trends as they pick back up and go forward post-COVID. These trends include the decline of old school retail, the rise of experiential retail, including food, fitness, and fun, which is what we like to call it around here, but really, that the experiential retail driven by the millennials and the changing culture. We believe these trends will pick up where they left off post-COVID, even though they've been wounded severely right now. We also believe leisure travel as well as base corporate travel will pick up and continue those trends going forward. Some of the things we don't believe in are old school retail, convention-based travel. We believe that will continue a decline post-COVID as people find other ways to meet through Zoom and other technologies. Technology is another core theme. The impact of technology on real estate is something I've been focused on ever since the rise of e-commerce. That's what got me initially into the Macy's deal when I started talking to the Macy's management as early as mid-2005, 2006 timeframe. We believe this is also going to have an impact on the convention-related hospitality, and that's another great example of how technology will impact us going forward. We've been asked a lot of questions over the last 6 or 7 months from our investors, and so I want to hit on a couple of themes I hear most. First off, we consider ourselves more urban developers rather than suburban developers as well as investors. The urban cores, especially in the Northwest, have been challenged. We believe this creates opportunity. We don't believe that these cores, which have been the center of knowledge and lifestyle for years, and everything trending towards them is going to go away. We do believe that this will evolve and change, and our current focus is really on the close-in urban neighborhoods right now that we think will thrive going forward. We're not shying away from the urban core, but we're being very particular about anything we do there and making sure that our basis and entry point is good. We found those markets to be very overheated entering COVID. The other and probably most common question is the office as we know it dead? I think personally, office was evolving pre-COVID already. The rise of WeWorks, technology, again, driving the way people work and flexible workplace. We at Sortis have always had a flexible workspace when people manage their own hours and schedule in the office. So we've been doing that for years, and we see a lot of people following this technology. Interestingly enough, since we're a lender and an essential business, we actually had a slow start during COVID where I was the only one in the office for months at a time. But since then, people have come back pretty quickly. I think really enjoyed being together. And I believe the office workplace will continue. I think flexible work will evolve and change how the office environment functions in the future. We've also had a particular insight in hearing from Amazon their theory on how office work's going forward. They've told us they want to open their office in our building January 8th, and they want to get people back to work. They think it's great for their culture and how they operate. At the same time, they're being sensitive to what's going on in the environment. I think the best example where office is headed is the recent transaction by Facebook acquiring the REI headquarters on the east side, just outside of Bellevue. They paid a record price, almost $1,000 a square foot for the REI campus. Now this is a group, Facebook, who said by 2010, half their people are going to be working remotely, but at the same time, they're out acquiring physical space. So yes, it will impact office. We think that just creates opportunity, but we don't look at the whole office category as being dead. We look at a continued evolution. Some of our other core investment strategies for this fund really apply across all our funds. Our geographic tendency is toward the Northwest. We like the Northwest a lot. We think COVID plays into this some, the outdoor lifestyle, millennial demographics, and other things Northwest have to offer. Focus on technology will all lead to growth in the Northwest post-COVID, continued growth. We also like the Western US, which is our primary focus for investment. So we'll stay focused in those regions. Another core tenet for us is risk mitigation. We always, as much as we like good real estate, we always want to have a business plan going in. Buying something cheap doesn't mean you're going to be successful. So we work hard on risk mitigation on every deal we work on. It's a combination of pre-leasing, good underwriting, creative restructuring, just really being focused prior to entering a transaction as to how we're going to execute on it, how eventually we're going to exit. I think our deal sourcing is probably the most unique thing we do. I would just describe it as a rifle shot. We don't bid on deals. We typically don't work with brokers. We often identify deals or situations and attempt to find an entry point because we like the deal, we know there's a problem. This plays very well in a COVID environment. All of our transactions to date in COVID have been done that way, and we'll continue to source that way. We're obviously a small fund, so we can't compete against the big boys once something goes to bidding, and frankly, anytime there's a bidding war, people end up overpaying. There's an amount of capital sitting on the sidelines, so people like us just have to be more creative and more aggressive to get into deals. The distress we're seeing is pretty much as we predicted when we sat down together and put our COVID strategy in place. It's been situational distress. Every one of our deals has been a victim of this, everything from partnership challenges complicated by COVID on down. That theme's going to continue for us. We're still looking at a number of bankruptcy, receivership deals, and we find complex, messy deals like this are the best way for somebody like us to enter a deal. Number one thing at times like this is going in on a low basis. You make your money on the buy. We're looking for substantially discounted assets, and that will continue as long as we are investing in this cycle. And then strategic monetization. This just means that we're opportunistic sellers. We don't have a program on exactly how we're going to exit, the time frame. We're going to be opportunistic. When you make all your money on the buy, sometimes within 12 months, you could hit an exit that makes sense. So we also may hold on these assets for the life of the fund. But I think being open to that and not having too fixed a strategy is important when you're doing deals like this in a unique environment. Sam, why don't you talk through some of our deal flow to date?
Yeah, thanks, Paul. And so just to pick up there on this, on our unique deal flow and the way we creatively source and structure and execute our transactions. So the Sortis Rescue Fund that we're here to talk about today, we launched in May of this year. And since then, we've been very busy, and we've actually executed on 3 transactions that we're very excited about. And the core theme of the deals that I'll walk you through in a second is we've been able to identify great brands and acquire them at substantial discounts. And so our first deal that the Rescue Fund did closed in mid-July. We acquired a controlling stake in Rudy's Barbershops, which was a Seattle-based men's hair salon. It was kind of the original hipster beer and a haircut shop. And they have generated over the 15 plus years they've been in business an unbelievably loyal fan base, and they've expanded quite substantially over the last handful of years. Rudy's was in a unique position where, because of their existing ownership structure, they did not qualify for PPP funding. And additionally, barbershops require very close contact. So as a result of COVID, all the barbershops had to shut down completely at the beginning of this. That forced the company into bankruptcy, where some partnership disputes arose. We were able to track down and build a relationship with one of the founders who wanted to mount a bid to buy back his company out of bankruptcy. And so we joined his effort. We partnered with the founder, with the founding partners, and we were able to successfully acquire the company and all of its assets out of bankruptcy. We took 20 stores out of bankruptcy. They are all back up and open, running at about 50% capacity with all of the required social distancing protocols in place. We've hired about 200 of the former employees back, and we've rebuilt an entire new corporate team from the ground up. We took the company out of bankruptcy with less than 5 employees. Including the founders. So we've in a short amount of time, we've not only rebuilt the company from a corporate level, we've been able to renegotiate all 20 leases and open the stores back up at 50% capacity, restore jobs, and we've been able to capitalize the company in such a way that once COVID is over, they will be in prime position to either pursue roll-up acquisitions, potentially sell the company, or potentially continue on as a successful, profitable company based on the way we've capitalized it. The other interesting thing with Rudy's is it came with an underutilized e-commerce business. Men's grooming and beauty products are one of the fastest growing categories in the retail space, and this was happening pre-COVID. We think that that is a trend that will continue post-COVID. And so being able to pick and acquire a great brand and a brand that we believe will be a winner post-COVID at a substantial discount is a perfect example of what we've been trying to do. So Rudy's was our first deal. Our second deal that closed towards the end of July, we made a small investment in an outdoor travel trailer company called Happier Camper. The company is based down in San Francisco, and they make small, modern, well-designed, very attractive trail behind your car camping trailers. which plays really well, and their company has been has seen an uptick in orders because of COVID, with the general population wanting to get outside temporarily of dense urban cores into the outdoors, go on camping trips, as those are the most viable kind of vacation opportunities that are out there right now. So the company currently actually has about a backlog of almost 8 months worth of units. And they are actually currently out raising a new round of funding that will help them expand that production capacity and continue to deliver units in a timely manner to their customers. And as part of that fundraising round, the company has converted the Sortis Rescue Fund's convertible note into common equity shares. And based on the valuation of the current financing round, the Sortis Rescue Fund's position will have increased by almost 40% in a little less than 3 months. So that's also a company that, coming out of COVID and actually during COVID, has performed exceptionally well. And we were able to make a tag-along investment at a lower valuation than what they're out currently seeking. And then so the third company and the third investment that we made out of the Sortis Rescue Fund closed about 2 months ago. And that is a company called Sustainable Restaurant Group. And they operate 9 sushi restaurants under the trade name Bamboo Sushi. It was a Portland-based company that had since expanded to California, state of Washington, and Colorado. And Bamboo Sushi was also in a similar position to Rudy's, where based on their ownership structure and a partnership dispute, they were ineligible for PPP funding. So as a result of lack of funding and COVID forcing all of the restaurants to close, the company was forced into filing bankruptcy to try to preserve the company and as many jobs as they possibly could to survive COVID. Similar to Rudy's, we were introduced to several members of the management team, and we were able to help propose and structure solutions. And we ultimately became the successful bidder of the company at the bankruptcy auction. We acquired 9 of the restaurants coming out of the bankruptcy. And I think Bamboo Sushi allows us to talk a little bit more of not just our skill sets when it comes to identifying good brands and acquiring good businesses, but it also plays into all of our other core competencies here at Sortis, mostly and namely real estate. So Bamboo Sushi is the prime example in my mind, because there were obviously, for a restaurant, your real estate and your location is number one. You can't serve your customers if you don't have a physical presence. And so that obviously comes with a lot of very complicated, nuanced real estate transactions that are typically forced upon restaurant operators that's outside of their skill set. Their primary skill set is to develop and run successful restaurant brands. And so by combining Sortis's real estate expertise, we were able to finish a very complicated construction project coming out of bankruptcy for Bamboo Sushi down in Valley Fair. We picked up a broken construction project that got put down during the bankruptcy, and it was only about 70% finished by the time we acquired the company. I personally led the negotiations with the landlords, the contractors, and our team here at Sortis and the Bamboo team to put together a structured solution that we could get the contractors back out to work and finish the store. We could do that in a very timely manner. We completed that in only 10 weeks while navigating very complicated building and permitting laws down in San Jose, California. Provided the financial backing, and then obtained significant cost savings for rent relief for the tenant. So that was, even though it was a restaurant location, it turned into a very complicated real estate negotiation that we were able to help structure a solution that worked for the landlord, worked for the contractor, and ultimately, and most importantly, worked for Bamboo Sushi and its investors. In addition to that complicated project, in less than 60 days, we've also renegotiated all 10 leases for the company that, based on today's math, should generate in excess of $500,000 worth of savings for the company for the next go forward 12 months. In addition to a substantial discount on the acquisition and substantial savings from implementing our turnaround strategy, Bamboo Sushi has also proven one of our theories that sushi is actually one of the best, if not the best, food for takeout and to go. The product stays cold, and it's not like soggy French fries and hamburgers, arrive on your doorstep. So sushi travels very well, and we've reconfigured several locations to optimize and do more efficient to-go business. And as a result, we're actually running almost 25% EBITDA margins on the to-go business, which, based on our surveys of the market, we're doing just as well, if not better, than several competitors in other restaurants. And on our current to-go business, we're doing almost as much business as we did pre-COVID with full indoor dining available. So we believe that by adding the robust takeout and to-go delivery, we should be able to achieve profitability ahead of our schedule. In addition, we've also built out a brand new management team, the Sortis Rescue Fund and the Sortis team broadly. We do not get involved in the day-to-day operations of the business. We hire some of the best people that we know in our networks. And similar to our other investments, we give them the capital, we give them the tools, and we give them all of our other skill sets so that they can be our manager of that business and put them in a position where they can simply focus on making that business as profitable as they can, and know that they've got the support of our entire staff standing behind them, ready to go and work for them as needed. And then, because of the way we've capitalized Bamboo Sushi, it is probably the best capitalized company in Portland right now from a restaurant perspective. And what that will allow us to do is, as we continue to execute our turnaround plan and stabilize the existing portfolio of restaurants, we will be in a prime position to go seek new A-plus locations, specifically in Denver and Seattle, as COVID begins to wane. So I think those three deals really hopefully give you a sense of our skill sets and the infrastructure that we have here at Sortis to execute on several complicated transactions.
So as far as our go-forward pipeline, we see the opportunity, which we consider almost once in a lifetime, to buy great brands that are operating businesses, really a needle in a haystack, and we don't see a lot more of those forthcoming. People who have survived this far, likely to continue to survive as things get better over time. We do have one more business acquisition, which was started about the same time as these. A fairly famous little donut company in Portland called Blue Star Donuts, who recently expanded down to LA. We helped guide them into a Chapter 11 bankruptcy process, and we are the plan sponsor. And we'll get about a 40% equity position at a small fraction of their pre-COVID valuation. They just did some financing pre-COVID, and we're probably 10 to 12% of that pre-COVID valuation that we're in right now. What we're looking at going forward is really real estate in the coming phases. It takes a little bit of patience for that to happen. The banks have been fairly kind to people hit by COVID. Most of what we've seen so far in real estate is, again, situations, primarily partnership or outside issues driving that. We have a Portland hotel property, a percentage of it in contractors, a partnership dispute, and we're acquiring a third of it. That came through a relationship with the other partners. That'll be, again, at a small fraction of the 2019 value. We're also working on a Seattle hotel property. We were actually working on it pre-COVID. The hotel is proximate to our 300 Pine Seattle project, so we know the neighborhood well. It's also driven primarily by Amazon business, which we believe will recover faster. So that one we're very bullish on. And we're also working on another bankruptcy deal that's a residential land. This was actually a pre-COVID deal, but the opportunity ripened during COVID for us to buy out the other partner that caused the bankruptcy. So we're working to structure that deal now and try to exit bankruptcy first quarter next year, but that will provide a multifamily and single family development opportunity in the future. So our sights are set on real estate going forward. Unfortunately, it takes time and patience, so we just have to remain aggressive and keep our ear to the ground looking for deals. We're not afraid of tackling more operating businesses, but again, they're kind of a needle in a haystack, and we've done a lot of inquiry and don't necessarily expect that we're going to get more that'll meet our standards. One thing Sam and I have in common is we take pride in the deals we've turned down. We have worked hard on a handful of deals and passed from them. I think what we're known for is the fast no. I mean, if it's not a gem, we don't waste time on it. But Sam, maybe cover a couple that we walked away from and how they played out.
Yeah, so one of my mentors in the real estate business always said, be equally as proud of the deals you walk away from as the ones you do, because that shows that you're working hard on them, but you also know and you have the discipline to know when a deal is simply not going to work for a variety of reasons that deals don't work. So we have spent, like Paul said, we're pretty good at giving people a very quick thumbs up or thumbs down if we think it's something worth working on. And then once we give someone a thumbs up, we work very intensely deep in the details to figure out what our entry point is and what the best way to use our capital in the most efficient and most productive and ultimately profitable way. So there's three very quick ones that I'll mention. The first was an outdoor lodging company, outdoor themed lodging company. They were in outdoor gateway markets, and obviously hospitality sector was significantly impacted by COVID. This company had a portfolio of what we thought were 6 or 7 very attractive small format, outdoor themed lodging properties in some of our preferred gateway markets out here on the West Coast, namely Bend, Oregon, and some places on the Gorge, and up in outside of Seattle. We made what we thought was a very fair, very attractive preferred equity proposal to the company to recapitalize the company and give it working capital to make implement some business changes to help survive COVID and put it back on firm footing. And they liked our idea so much that one of their existing investors did the same thing for the company. So, that's one that we unfortunately lost out on, but we provided a creative solution that worked. They recognized it, but ultimately they did it with existing internal investors instead. A second deal that we were looking at is a company called Punch Bowl Social. They run big kind of arcade bar style experiential entertainment facilities where you can have a drink, play some shuffleboard, among a variety of other activities. They were out looking for fundraising. We spent a little bit of time kicking the tires, but ultimately their valuation that they were asking was substantially higher than what we thought the underlying business was actually worth. And so rather than bidding and raising our pricing, we were confident in our underwriting abilities. We thought we knew we had a good handle on what we thought the company was worth. And they had a differing opinion, which is fine, but that was the moment for us to walk away and not stretch and not do something imprudent with our investors' capital. And then the third deal actually started as a preferred equity deal, but it morphed into a loan deal. And I think that's important to mention for the group today, because as an alternative asset manager, having our 4 funds and our 4 distinct mandates, we see more deal flow than the average company that only focuses on one thing. So several of our real estate deals can turn into loan deals can turn into business deals, and all the combinations thereof. So by being able to see a broader array of deals, given our various fund mandates, we see more deal inflow, and we're able to understand deals better and understand, maybe the original concept of the investment that came to us is not actually the best one, and we can figure out a different strategy that works. And so we get good cross-pollination across the funds, but each fund does ultimately have its own mandate. So one fund is never, used at the expense of the others. So we are very strict, on that point. And so we ended up making a loan deal on a apartment complex right on the waterfront in Kirkland, Washington. It's a piece of property that, will never be rebuilt based on the local zoning codes. And it is, Kirkland's a nice, wealthy, little enclave outside of Seattle, and the waterfront's beautiful. And as, most people know, they're not making any more waterfront property. So the deal originally came in as a preferred equity deal. And after we worked on it for about a month, we recognized that the preferred equity solution was not ultimately one that, both met our fund yield requirements, and it didn't meet the requirements of our counterparty. And so we converted it to a loan deal out of the Sortis Income Fund, where we use capital to solve a problem, and we can be very creative, and we can tailor solutions to a borrower's need. And so that turned into a loan deal, and we ultimately saved the property from foreclosure 2 days. We closed less than 48 hours before the foreclosure sale was scheduled to happen, and ultimately that deal will generate good returns for the income fund. And it allowed that borrower who was put in a difficult situation because of COVID to retain ownership of their asset, execute a business plan over the next 6 to 9 months, and then position that asset to be sold and and generate proceeds for that borrower. So those were all good deals that we liked and we pursued, very diligently. But ultimately, for one reason or the other, they did not end up, being the right solution, or in the case of Punch Bowl, we had to walk away due to a difference on the pricing valuation. So again, we're as much as we wanted to do those deals, we're also very happy that we do have a very disciplined approach here, and our whole team is constantly in communication with each other. So that allows us to get different perspectives and see different angles of a transaction, and we can know, pretty quickly when a deal is worth pursuing, when a deal is worth walking away from, and what deals are simply just not worth spending our resources on. So I guess just to follow up and kind of wrap up the presentation portion of this, and again, we thank everybody, for attending this morning. And so our go forward strategy with the Rescue Fund and COVID generally, as Paul mentioned, is we do think real estate will return to our primary focus going forward. Real estate deals, just given the nature of real estate itself, take a little while to transact. And we need to just be patient. We're tracking, in addition to Paul's pipeline, we have a list of some other deals that we're tracking in the background and working on figuring out the right way to enter into those deals. And so we just need to keep being persistent and keep identifying those opportunities, and doing that with a great deal of patience, knowing that these are unusual times. There is still substantial amounts of situational distress out there. And once we find those, we know and we're confident in our abilities to go ahead and sign on to those deals, structure and execute them successfully. And so with that.
So just as a closing point, I mean, Sam's making a good point there. I believe we're just at the beginning of the real estate opportunity. We have identified a handful of real estate deals we're working on. I think it's a 6 to 9, maybe 12-month run for real estate. So we're looking forward to trying to make some of these happen. And we think there's going to be, probably short of the Great Recession and maybe even better, some once-in-a-lifetime opportunities on some of these deals. So with that, let's jump into a little Q&A. There's a handful of questions here. Catherine Richards asks, what are your exit strategies for each of these businesses? We think about that before we enter them. Fortunately, we've got some expertise on the team with people that have worked in private equity and understand private equity exits, which we think is most likely for both these businesses based on their size. They're small private equity candidates now, and we feel that once we survive COVID, maybe opportunistically expand the businesses, that we should be able to make either a full exit to private equity or potentially a partial exit capitalization with some growth capital, and then an eventual sale of the business. As I mentioned earlier, we are going to be opportunistic. We've already entertained potential offers to acquire both the two businesses, and we're in very active negotiations right now on Rudy's for a roll-up strategy with a number of different groups, which would likely involve them going through a Chapter 11 and eventually combining with us. So we think that there are definite clear exits for each of these. Someone just asked about PPP funds. Yes, both Rudy's and Bamboo were eligible for PPP funds. As an acquirer of substantially all the assets of an eligible company, you can get PPP, and we did acquire PPP for each of those businesses. That's what allowed us to hire back in both businesses roughly half the people so far, with our goal being closer to all of them by maybe Q1 of 21 or Q2, depending on how COVID plays out. So yes, we did acquire PPP. Larry just asked, what other industries are we investigating? From a business standpoint, we really are looking for anything that's had a substantial discount. It's really the time to make a buy. So we're really focused on that narrow group of businesses which have been hit the hardest. And that really has been, the hospitality sector. While Rudy's is haircuts, it's really a hospitality related business. So that has been our focus. If something dropped in our lap with a substantial discount and it fit in our expertise, we may consider it, but we have considerable expertise in our team in the hospitality related sector. So that's why that's been part of our focus, that combined with the discounts we're seeing. We had a question about what share level returns on capital has been deployed already. Tough to really calculate returns at this point because we haven't exited anything. We feel our buys on these companies, we'll give you an example of Bamboo. Bain Capital invested in 2018 when they had 6 stores at a $40 million valuation. We acquired the company for a little over $2 million, or about 5 cents on the dollar. So we feel that's definitely a once in a lifetime buy. We've already talked to some of the potential private equity exits about that valuation, and they feel if we survive COVID and show that we can expand post-COVID, that we could easily get back to that $40 million valuation. So, that would be significant multiples in a fairly short period of time. No one knows exactly how long the COVID impact's going to last. We feel that things will normalize at some point in 21. We hope sooner rather than later, but we're planning, break-even strategies to tread water, even maybe slightly profitable as long as necessary. Somebody else asked about a 1031 exchange. Unfortunately not. It is a fund, so it's ownership in an LLC, so it's not eligible for 1031 exchange. We wish. I'm sure there's a lot of 1031 exchange money out there that would like to invest, but we can't do that, unfortunately. Somebody asked about interest level in the rescue fund, how many of the 100 investor slots have been filled, and how much capital has been raised so far. I'll let Sam talk about the details on that. And we've done, in all these investments, a combination of rescue fund and direct investor investment. But Sam, can you give an update on the rescue fund itself versus the total investment?
Yeah, so I think based on last numbers, we've raised approximately $2.5 million into the rescue fund, and we've filled up anywhere between, I don't have the number in front of me exactly, but somewhere between 15 and 18 of the investor slots have been filled to date. And one thing I would note too, even though, compared to the size of the transactions we've been executing on, based on the way we get into these deals and find the entry points, we're able to generate substantial returns and being very efficient and using a limited amount of capital. So that's one of the primary ways that we think about risk management, is how can we be efficient, with the dollars we have and use those dollars to drive as outsized a return as we possibly can.
Yeah, and I would say, size-wise too, while the companies were large from a revenue standpoint, the investments are actually fairly small when coupled with PPP. So as we start moving into real estate, the numbers will get larger and the businesses will be a fairly small part of the overall portfolio by the time the fund's fully invested. So we had another question about taking new investment dollars. Yes, we're still taking new investment dollars. We're taking money for a year. How will they be treated? Currently, the investment dollars are taken in at the same level as the original dollars. As soon as we have some sort of mark on the existing assets, which may well happen in the near term if we decide to monetize one, then we will have to mark the fund to market and take dollars in at a new level, but we haven't had to do that yet. So today you're still getting the advantage of being able to look in the rearview mirror and see the investments. The investors that are in are getting a preferred return for the time they're in, so that's the advantage of getting in early. And we had a question about his ownership split between funds. The answer on that is typically not. It's typically focused on one fund, but we are not prohibited from doing that. So we can have, if it crosses two mandates, then we can have investment from two funds, which is pretty typical in the private equity world if it fits within two mandates.
If that happens, it's important just to note that the funds are treated equally. So one fund does not end up at the expense or the benefit of the other. So if two funds end up in the same transaction, it is on equal footing for both funds.
Time for maybe another question or two, but there's one here about tax reporting. It's an LLC, so investors receive a K-1 at the end of the year. And looks like all of the questions at this time. So thank you again for attending. If there's any specific questions we didn't cover, or you want to have a conversation directly with Sam and I, we're always available to do that. Continue to follow us online. We've got a great new marketing team led by Paige, who coordinated this, who has done a good job of communicating out to the market what we're active in and what we're doing. So if you sign up for our weekly newsletter, that's a great way to hear what we're up to. Thanks again, everybody, and stay safe, and we'll talk again soon. Thank you.